Well, thanks for joining us, everybody, and good to have the opportunity to take you through. To start with, just a little overview of the company for those of you that don't know the company, and then I'll dive into our results and where we see the future opportunities coming for growth, not just for us, but also for the sector or our profession more generally. So our listed entity is WT Financial Group. As Paul has mentioned, we've got two main divisions to the company, which is our primary division is our B2B licensing for advice practices. And these are our brands, Sentry, Synchron, and Wealth Today. All of those businesses comprise independently owned financial advice practices. We've got around 400 practices that we support, and their advisors all operate under one of those three Australian financial services licenses of ours as authorised representatives. Whilst we have those business-to-business facing brands, each of those financial advice practices in those groups has their own consumer-facing brand. So they might be Mary Smith and Associates or Esperance Financial Planning, etc. So really the consumers are interfacing with their sort of local brand in their own market, and our brands are really business-to-business brands. So whilst we have those different cohorts of advisors, is all of the services that we provide to the advisors are provided under our Wealth Advisor banner, so that's enabled us to streamline and really maximise the range of services that we're providing our advisors and their clients, and to use the same personnel across supporting each of those three cohorts of advisors. Moving or structuring our business in that way has also opened up an opportunity for practices that are either self-licensed or even licensed by another licensee to access things like our education and training, our consumer marketing tools, and so on under that Wealth Advisor banner. And then our other division, which is about 5% of our revenue, is our direct-to-consumer division under Spring Financial Group. So this is a direct-to-consumer financial advice, mortgage brokerage, tax and accounting practice. Really important part of our business, even though it's a small contributor to revenue and profit. What it means for us is that we don't need to second guess what it's like for the advisors in our independently owned practices to run their own practice and to sit in the room with clients every day. We don't need to second guess what regulatory and legislative changes might mean for either the advisors in our group or for their clients. So we call that our research and development lab. Small contributor to revenue or profit, but a very big contributor to the culture and us keeping it real with the services we're providing our advisors. So Abby, if we can hop on to the next screen. Just putting us in perspective in terms of the market is through our acquisitions of Synchron and Sentry Group over the last few years, we've now emerged as amongst one of the very largest advisor networks in the country, 400 plus practices, a total of around $18 billion rather of advised money in that group, around $360 million worth of in-force insurance premiums, and we write about 25 million of new insurance premiums through the group each year. So quite a significant player in the space. And on to the next slide, please, Abby. People often ask me, how do we earn our revenue? Well, we collect all of the revenue through the network and we retain a percentage of that revenue. We also charge our advice practices base fees, and then we have a range of user pays fees with our practices as well. And also we've recently launched those direct to advisor or self-licensed and advisors in other networks, those services where people can come and attend our conferences and our education and training and so on. And then we also have our B2C revenue, which is our advice, accounting and mortgage brokerage fees. So next slide there, please, Abby. What I'm most pleased about is we released our indicative results a couple of days ago on Tuesday. We don't expect any changes to these in the audited results, but we wanted to get out ahead of the audit being completed and let the market know where our numbers were indicating for the year. We've seen gross revenue growth of close to 60%, up to a total of 162.49 million. That's driven a gross profit of a bit over 17 million, which is a 54% growth. And very pleasingly, our earnings before interest and tax have nearly doubled to 5.59 million. And after accounting for tax, we'll hit 4.3 million for the year. And interesting equation on the tax for us, we've got carried forward tax losses. So whilst we've got a statutory calculation that'll drop us down to 4.3 million, there is we won't have any cash tax liability arise. So through to the next slide for us. Just looking at where our future growth opportunities are, is we've definitely got the opportunity for organic growth through increasing the number of practices in the group. So we'd see organic growth in our base fees there. We've got that opportunity in terms of launching our wealth advisor branded services out to self-licensed practices and to our education services and these sorts of services out to both smaller dealer groups and advisors in those groups directly. Probably the biggest opportunity is in our share of revenue with our advisors. And I'll talk shortly about the enormous opportunity for growth in financial advice across the next sort of 5 to 10 years. And a real key for us is that with the vast majority of our practices, we're sharing in their revenue. So we're very motivated to help them grow their revenue accordingly. That keeps us on the same page as them and helps with our overall profitability. And look, over the last few years, as growth in our B2C business has taken a back seat to our growth in our B2B businesses, but we see an opportunity to sort of kickstart that growth again now that we've completed these acquisitions and we can turn some and integrated them, and we can turn some management attention back to growing our B2C revenue as well. All right, on to the next slide, please. I talk to our advisors and to any investors ad nauseum about the incredible opportunity we're faced with in this profession now, and it's driven by an amazing supply-demand imbalance that has emerged. Over the last 10 years or so, we've seen a significant decline in the number of financial advisors in Australia, down from a high of about 26,000 to about 16,000 now. We think that number's going to net down to about 12,000. We've got about 1,000 advisors retiring every year in Australia. And at this stage, only about 300 or 400 new entrants coming in because the barriers to entry have been set so high. So on the supply side, there's a veritable chokehold that we think will remain for the foreseeable future. We think the market's going to stabilise around 12,000 qualified professionals for the next decade or so. So next slide, please. That's all happening at a time when demand is absolutely burgeoning. We've seen major increases in the key cohorts that advisors serve, which is the wealth accumulator market in their sort of 40s. We've seen growth of 8% between the last two census. Pre-retiree market up about 6.2% to an incredible 7.9 million people. And most significantly, those sort of that have entered retirement, that market has grown by close to 20%. So it's an amazing growth in the cohort that's traditionally serviced by financial advisors. Household income of that cohort up 21%, family household income up 22%, and the number of households with more than $3,000 a week of income up a fantastic 16% up from 16% of Australian households between the last two census to about 1 in 4 households now. So incredible growth in the number of people that are available to be served. But if we hop on to the next slide, the other thing that's happening is the key components that most financial advisors are dealing with in terms of asset class are people's superannuation assets. And this is seeing incredible demand growth or growth in those assets, nearly $2 billion a week net. So we've got now a superannuation pool getting close to $3.5 trillion with 2.3 billion of inflows a week. outflows of member drawdowns of 1.7 and asset growth of 1.3, netting to nearly 2 billion a week. So there's no stopping this incredible weight of both people and also capital that's coming into that sort of demand space for financial advice, all at a time when there's a real chokehold on the supply of professional advisors. Quickly onto the next slide for us. And fee preparedness in this country, you'll often hear people talk about Australians only being prepared to pay, a relatively modest amount for financial advice. But the reality is 1 in 20 Australians say they're prepared to pay $27.50 a year for advice, another 1 in 45,000 a year. All of this nets down with 12,000 advisors to a fee preparedness opportunity in the market of about 440,000 per annum of ongoing fees per advisor. And that's before we take into account upfront fees for advice, implementation fees, insurance sales, and ongoing personal insurance commissions. So, we're facing a market now where the average advisor should be targeting about $650,000 or $700,000 a year. We think that's where the market's going to get to. It's around about half that at the moment. So the profession is definitely short selling itself considerably, and that's a key driver for us, is to work with advisors to really maximise the opportunity before them, and for us to benefit from that to help drive both our revenue and profit. Next slide. Okay, quickly onto the board. I'll publish this deck later, but you'll also find we've got a very experienced board with a great range of talent and experience in financial services. Same goes for our management team. Abby, if you flick through to that, we'll get this up. Really great experience, decades of experience in this space, all coming together in the company to help advisors take advantage of this incredible opportunity, and it's reflecting in our results. So Paul, I'll finish off there. If we just flick through to the last couple of slides of the management team, and also finally onto our strong support in our shareholder base, including execs and management owning about 1/3 of the company.
Thanks, Keith. And got plenty of questions. Actually, I do get incoming texts during your presentation, and one come here to make you laugh, Keith. This company should have a higher market cap. So,
well, you're not going to get an argument from me, Paul. I think, look, the sector, people are not understanding the opportunity in this sector. There's been a lot of negativity around it over the last few years in the wake of the Royal Commission. But we saw the opportunity. Some say that we ran into a burning building by really going boots and all into this licensing space. But we saw the opportunity, and we think the market will start to understand it properly now. And we're really looking forward to that reflecting in time in the share price.
Let's just talk about some of these results. What would have been the key drivers of WTL's performance, and what was the largest group revenue contributor?
Yeah, well, definitely the B2B, it's about 95%. So that's the fees that we collect from the practices we support, plus our sharing revenue with them. And the key to our success has been bringing together these 3 disparate businesses and consolidating and rationalising both the network of practices and also the way in which we serve those practices to bring it all under the Wealth Advisor banner. So we've really driven efficiencies, and now we can do the fun stuff and help the advisors drive their top line to help drive our bottom line.
And then, Keith, going forward, what do you see as the key drivers of revenue for the group?
Look, more of the same, I think, Paul. It's really that helping advisors build better, more profitable practices themselves through making sure they've got their proposition to clients, including their pricing proposition right. We see that big increase in average advisor remuneration coming over the next 1 to 3 years, and we will benefit from that through our revenue share with them. And we also see getting more of them refocused on personal risk insurance, so that they're making sure they're maximising the risk management for their clients, and in turn maximising their own revenue and asset values in their practices.
And Keith, you also made some astute acquisitions. Do you plan to make more?
I won't say no to it, Paul, because there's definitely more consolidation coming. I think others are grappling with how they transition into a modernised environment. Many of the dealer groups went down the path of fixing their fees with their advisors, which I think was a mistake, because it makes you misaligned in terms of how you support your practices, and it also fails to recognise, you're buying and selling risk in this game, and so you should be aligned like that. So we're definitely seeing opportunities come across our desk, but it's not a deliberate strategy anymore. We've built scale into the business so that we can underwrite the right infrastructure to support our advisors. With that job done, I'm still interested in acquisitions for the right ones, but it's not a critical component for our strategy anymore. So we'll just assess them on their merits.
Okay, and one from the floor here. With the reduction in advisors and the climbing money to be put under management, how do you see WT capitalising on this?
Well, the capitalisation is really through helping advisors get their pricing proposition right. And one of the drivers to that is the amount of money they're helping manage, but it's not the only driver. Like our fees with our practices, is we believe advisors should have a component of both fixed and variable, or what we'd call the risk-weighted fees that they're charging. So there's two things driving it. It's that growth in the capital pool driving that sort of variable bit, but it's also just the growth in this weight of people coming through that are nearing retirement, entering retirement, etc. So it's really this modernisation into a profession. It's less about the assets being managed and more about the outcomes, and a lot of those are strategic outcomes that people are delivering for their clients.
Okay. And just to finish up, Keith, any plans on a dividend in the future?
Look, with 30-something million shares, myself, Paul, and the board and management owning more than a third of the company, investors can and shareholders can have it in their mind that we are completely aligned in that regard. In this last year, we had very strong cash flow, but we also had some payments to make out on the acquisitions, both acquired liabilities and also upside payments on the performance of the two acquisitions that we've made recently. So, our positive cash flow was tempered a little bit with those non-operating outflows, but you can have a look at the shape of the cash flow and take that into account and see that the opportunities are rising, and the board will deal with that at our next meeting and decide ahead of our final results announcement whether we'll make a modest dividend this time around or not.
Keith, it's been an absolute pleasure having you on. You have a great weekend.
Yeah, thanks so much, Paul, and thanks everyone for joining us. Cheers.